Jeff, Zach, thanks for joining me.
Hey, Steve.
I
Thanks
see.
for having us again.
Hey, good to have you. We are talking about the exciting topic of mortgage rates, but seriously, an important topic. Before we get into rates and what's happening in real estate, just encouraging everybody, visit the website, selectfincap.com, get on our free newsletter to get this type of news and other in the real estate space, as well as a look at exclusive real estate investment opportunities. Jumping in, mortgage rates. Um, Although they usually fall during periods of uncertainty, we've actually seen them be flat, maybe even up a little bit. We get into what's causing that a little bit later, but the impact matters. It's not, we're not really seeing mortgage rates dip much. And we're continuing to see some issues with people buying houses. Some signs that they're jumping in, and some signs that they're now pushing things out. What are your guys' thoughts on how mortgage rates are impacting us, particularly residential real estate here?
I think I typically, look at this, and looked at it in the past too, but I think from the side of consumers who are buying, residential real estate as a place to be their home, they become a lot more picky when the cost of the money is more expensive. Typically, they didn't care as much because it was cheaper, and they figured, well, the value of real estate continues to rise. I may buy it now and I can sell it in a year or two, live here a little while, and I can go find something a little bit better or something I like a little bit more. I think as people realize maybe that rates may be stagnating or even going up, that may not be a possibility. So they're a little bit more picky about what they are, want to buy. The inventory out there is stagnant for for a lot of reasons, but people have seen those houses, and they're not as keen on going to get that.
So location and quality, we talk about it all the time. Great location and I would say great quality, and even then quality is not going to be trumped by location. So mostly location followed by quality. You're watching good products still go and go quickly and be hotly contested. Um, with all of the uncertainty, Jeff, I agree with you. People are less inclined to move because they're not sure what's going to happen. So they're more conservative with their dollars. Banks are more conservative with their money. Bond markets are uncertain. Mortgage rates go up. It becomes more expensive. So the only thing that you can have here to kind of loosen the market would be price correction. And that might be what you see on the horizon is, hey, there's a house there. I'm not interested at that price or this mortgage rate. But if you take a 25 or 35% discount on that price, does that change or move the needle? Are you then interested in buying it at the higher interest rate? So I think that everyone that is uncertain and everyone that is dollar conscious at this point is going to be motivated possibly by a coming pullback in housing prices.
Yeah, I would just add that that's, really all good points, just with the caveat that, local markets may differ, right? And so that's something you need to pay attention because we certainly see some markets where you could have a price correction or maybe there was oversupply. Um, I mean, I don't have a crystal ball, but Austin certainly was a market that, got a lot of supply dumped into it. And then we, just did a video on some areas of the Midwest having an undersupply. So you really want to know your local market. The mortgage rates is just kind of interesting. We're just not seeing rates go back to super lows. And I think there's starting to be some recognition from people that they're just not going to get super low rates and they're just gonna have to pull the trigger and buy. And then, that's coupled with recently we've had some economic difficulties and actually seen rates go up. And some of that's around tariff fears and the potential that we're seeing some people like the Japanese or Chinese potentially dumping treasuries. We also might be seeing some unwinds of some arbitrage trades going on. All that stuff should be self-correcting in a bit, but it has meant that people were kind of expecting with this economic trouble we might see rates go down, and that really hasn't happened. And we're just kind of back to where we're at is people just aren't getting a break in financing costs. And it goes back to what you guys are all talking about. Know your local market dynamics, know your pricing. And you just can't depend on cheap financing to do it or that's going to be around the corner anytime soon.
Well, I think people also need to change their mindset from the side of it. Maybe they do get some cheaper pricing. Maybe it's in the fives. Maybe it gets down in the fours. But the days of 2.5s and 3s and 3.25s, those days are probably long gone for, for the foreseeable future.
Yeah, and people might just need to celebrate it if they're sub sevens,
Yeah,
and that's the new world we're in. And we're starting to see some data that people may be accepting that, and understanding that if they need to take a new job or if they need to start a family or something, they just need to accept that they're in a world of what historically actually has been more normal or average rates, just not in many people's lifetimes what's been normal rates. But the new normal may be the old normal of of rates that are well above twos or threes.
Yeah.
right.
Okay, let us know in the comments what you think. If you enjoyed the video, give us a thumbs up, subscribe if you haven't, and again, visit the website selectfincap.com. Subscribe to the free newsletter and get a look at exclusive commercial real estate investment opportunities. Thanks a lot, guys.
Thanks, Steve.
Thanks, Steve.